and welcome. Sorry if you just caught our little audio glitch, but we're back, and hopefully you can hear us better this time. I'm Claire McKee, and this is Real Talk San Diego. We're bringing you the business of life in America's finest city. My friends from Golden West Management are back, and we're sharing everything you need to know about the new tax laws and how those could affect your real estate investments. So hello to Jason and Yuri. Thanks for joining us.
Thank you.
You got to tell me, you just went on a little annual ski trip. How was it? We're all still walking, like no one came in on crutches, so give me the rundown.
So just to correct you, it was a snowboarding trip.
Yes.
Because in our office, we all board. We don't ski.
We all board.
We're cool. It was great. It was a really good time. The Big Bear is really close to us. It's only 3-hour drive.
Right.
So it's nice to take the meetings to the slopes and just more of a team building. And it was really fun. I gotta tell you that the next day I was really sore and in a lot of pain, like walking funny, but today I'm actually feeling a lot better.
If you're in the property management business, you absolutely have to take a couple hours out to go take meetings on the slope. And that's what we did. Just like Yuri said, everybody could get up there, could get on their board. Greg, okay, next year you might be a little bit better. But everybody did a great job. And again, you got to do that once in a while to make the office fun.
Yeah, company culture, that's so important, right?
Right.
Getting out there and experiencing things together.
Mm-hmm.
Super cool. And so we have to give a little birthday shout out because our homegirl Yuri here, she is turning 21 again this week. Hey.
Again, thank you.
What are you doing? Going to Vegas? Like, what do you have planned?
I actually may go to Vegas, but you know, in years past, I would over-plan my birthday. And as I'm getting more mature,
Not older,
My
more
second
mature.
21st birthday.
just more mature, I kind of let the chips fall where they may. So
You're so wise.
not setting up such an expectation when you get let down, you know, you just get surprised.
Totally.
Well, 21st birthday, you got to be bar hopping.
All right. So we'll start at the Brigantine.
Yeah, 21.
We'll start at the Brigantine on Thursday at noon if you want to join Yuri for her birthday cake. That's where we'll be at Golden West.
All right, I'm there. Let's do it. So once again, this is Jason Yoss and Yuri Jacobo. They're with Golden West Management. And then we also have our certified specialist in estate planning, trust, and probate with Blanchard, Krasner, and French, and that is Edward Schlesier. Welcome back.
Thank you, Claire. Good to be back.
I bring you on the show to challenge myself to say your last name.
You did it very well.
Did I do okay?
What I like to say, it's leisure with an S in front.
With a Schlesier.
Schlesier. There you go.
Schlesier. Got it, Ed. So thanks for joining us again. As
My
you
pleasure.
know, I like to bug you guys and ask you some weird questions to start, and we're going to play Would You Rather today. So these are some fresh eights for you. So, Jason, would you rather win $2 million or have a personal assistant / butler type of situation for free for the rest of your life?
I'll take the personal assistant butler situation.
Yeah, forget the money.
I couldn't survive without, and Yuri knows this, hey, did I put my keys somewhere? Hey, where did I put that piece of paper? Did I do that? Constantly trying to remember what's going on. So if I had a personal assistant butler,
Help you out.
that would make me more than $2 million.
Faux free. Hell yeah. What about you, Yuri? What
I
would you
take the money.
You take the money
How
and
much-
run.
Shoes I can buy with that?
Sure.
You don't need the butler.
I don't need the butler.
Okay.
I have boyfriends for that.
Oh,
I'm
okay.
totally kidding, but I would definitely take the money.
Ed, would
too.
you take the money or would you take the assistant?
I'll go for the cash.
Yeah, you take the money too?
Absolutely.
What, would you buy shoes with your money or?
Hell no.
No.
Buy some real estate.
There you go.
There we go.
Perfect. Right on topic. So, coming back to you, Jason, I want to know, would you rather have 3 real estate investments generating income for you, free and clear, or would you rather never have to pay taxes ever again?
Ooh, that's a tough one. Never pay taxes again. I think I would go with never pay taxes again. And I love real estate, and I don't want to knock not having real estate, but not pay taxes with the way, especially the state of California is going. I want to say not pay taxes.
Yeah, I feel it. Yuri, what about
You
you?
took the words right out of my mouth.
Same page.
Honestly, yeah. I mean, taxes can be kind of a headache, and
It's
from
sad.
looking at my parents and people around me, it just gets harder as you get older and more financially stable.
The more money you make, the more they take.
Right.
Yep, more money, more problems.
And
Ed,
the expert, yeah.
Yeah, Ed.
how do you feel about this?
Definitely no taxes. Absolutely.
We're
No
all
question
in
about
unison.
it.
Perfect.
We're all in unison.
When you think about where we're paying taxes, you know, it's not just income tax, but it's property tax, it's tax on your gasoline, it's sales tax. You eliminate all that,
Oh, man.
no brainer.
Smooth sailing. All right, cool. So we're all on the same page. This isn't a would you rather. This is just a question that's going to tee me up for the next would you rather. What was the first car you owned or drove?
Toyota Celica. It was a red car that my dad let me drive. And of course, I think I had driven it for maybe a couple weeks. And unfortunately, I got in an accident. And there was no more car again.
Oh.
I know.
Okay, what about you,
The
Yuri?
first car.
First car you had.
It was a Ford Explorer. It was an ugly green. It was 2 doors. It had a sunroof, and it had really cute quirks. Like when it came in reverse, you had to just wait a little bit, and it would just go back. So I'd be like, guys, like no cars behind me for at least 2 minutes before I'm able to leave. So I would always park so I can leave forward, but when I wouldn't, it was cute though. It was first car, you know.
I love to hear those stories. Ed, what was the first car you
A
had?
red 65 Mustang convertible.
Oh, so you're going to love my next question. Okay, so would you rather drive the brand new Acura NSX, one of my personal favorites, or a 1969 Fastback Mustang GT?
Ooh.
Nah, gotcha.
Right.
Yeah.
So I
Tough.
don't know much about either. I'm not a huge car guy, but muscle car sounds like a way to go.
New or old, though, is the key.
Oh, definitely older. I mean, if
Yeah.
you're not going to go vintage muscle car,
Yeah.
I mean,
You're gonna go with
no
the lead
offense to the
sled.
new stuff, but older original sounds a lot better.
Totally. Yuri, what do you got?
I will take neither and take like a Lamborghini.
Oh,
Thank you.
okay.
Of course.
Excuse me. The Acura isn't good enough
I'm
for
actually
you.
not knowledgeable about cars, so I really don't even know what you're talking about.
Oh, no worries. I love cars. So, what about you, Ed?
65 fastback for
Yeah,
sure.
yeah,
Absolutely.
Yeah, you're taking the oldie. All right,
Yeah.
oldie but goodie. I'm going to have to say I would probably take the new one, but hey, what do I know? Guys, we are just getting started, but if you like what you see, be sure to click follow on the live feed so you can get notified each time we go live. And drop us a comment. We'd love to hear your questions. If you just want to give us a shout out and tell us we're killing it, we'd love to hear that too. So stay tuned. We are going to talk with Edward Schlesier and Jason and Yuri. I almost said Jason and Yuri Jacobo like you guys were married. They're not, but they are both with Golden West Management. So, Ed, I want to start with you. Why don't you just give us an overview of your business and practice area a bit?
Sure. So I am an attorney with a law firm, Blanchard, Krasner, and French in La Jolla. We have 16 attorneys and 2 offices. We opened an office in Reno, Nevada about a year ago.
Very cool.
I'm responsible for the tax, trust, and estate group,
Okay.
practice group. We have 8 practice groups, so we're a full-service firm.
Wow. So even more outside of your scope of practice. You cover it all.
Absolutely.
Very cool. Well, congrats on opening the new location.
Thank
That's
you.
new news since I've seen you last. So I think everyone wants to know what's going on with the new tax laws. Is it a positive? Is it a negative? So just generally speaking, like, should we be nervous or is it not so bad?
Well, whenever you have a massive change to our tax law, which we just had, first time since 1986 that we've had this big of change, it's going to affect people differently. I think on the whole, the majority of taxpayers will pay less tax. But there will be some taxpayers that will pay more, especially in states like California, where now we have limitations on our deductions for state and local taxes,
Right.
which will affect higher income taxpayers.
Yeah, so places like California, New York, all the high tax rate states, I'm assuming, will be affected more so.
I think so.
Understood.
I think so.
So on the other side of things, why don't you tell us a little overview about what Golden West does, what you're all about?
Absolutely. Well, Golden West is a residential property management firm. We specialize in your single-family, condo, townhome property. We also do multi-unit, multi-family, 4 to 40 units, but our focus is residential. We have over 1,000 properties in 3 states, Arizona, Nevada, and here in San Diego. What we're going to cover here in San Diego is probably the Oceanside Vista area down to maybe your PB area, and then from the coast out to the 15. That's our specific area and coverage.
Yeah, and here at Golden West, we are a service-driven organization. We are committed to excellent communication. We will procure A-rated tenants for you, and that doesn't only mean tenants that are going to pay the rent on time, but tenants that will take care of your property, because we understand how important that is. And most importantly, we're your local market experts. We know, you come to us, we know what the rates are here. And we're not just realtors who happen to do property management.
That's a big one.
We're licensed agents that focus on residential rentals, which is really important.
Absolutely.
Hit me with your slogan just because I like it and want to hear it.
Rent it like you mean it.
Hey, run it like you mean it. So, Jason, tell me, what is kind of the difference between a multi-unit versus a single-family investment?
That's a good question. Generally speaking, a multifamily is just going to be a property with more doors, more units involved versus a single family. So a single family is your standard condo, townhome, your detached house where it's one person's living there, or it's meant for one occupancy, where a multifamily is multiple.
So, Ed, maybe you can talk a little bit about the tax consequences versus a single family or a multi-unit.
Well, even before the tax consequences, there could be different financing options. So
Okay.
when you're talking 1 to 4 units, you fall within a classification of loans that are typically more favorable. You get over 4 units, you have what's called a commercial loan, and so you have a whole different types of loans that might be available to you.
Is that like higher interest rates and things of that nature?
It could
or?
be
More
a
money
difference in
down.
interest rate, but typically the term of the loan is shorter. So you'll have to pay back the loan in maybe 10 years or 15 years,
Gotcha.
where 1 to 4 it could be 30 years.
Okay, understood.
Now on the tax side of things, when you're holding real estate for investment purposes, it's a business. That's the way to think of it.
Okay.
And so the revenue of your business is rent, and all the expenses related to your property are deductions that you can report, and the difference you're going to pay tax on.
Understood. So that's something to consider when you're looking to make the investment on the forefront is what are the improvements you're going to have to make over time? What is the tax you're going to have to pay to really determine whether it is a solid investment to make, right?
Yeah, all investments you have to look at cash flow. And so you have to look at, here's what I'm putting out, what am I getting in return this year and into the future.
So it's not something so much that you could just open like a higher line of insurance, or would you suggest somebody starts an LLC like it is an official business? Is that necessary or required?
And that's a question we get on a regular basis. Ed, is
So-
that- that's what clients are asking. What should they do with their entity when they buy a property?
That's a great question. There's different ways in which you can hold title to real estate, so you can own the property. You can just go out and purchase it in your individual name, but that's going to have a set of consequences.
Okay.
Or you could set up an entity like a limited liability company, and then have that entity purchase the property and be on title.
Okay.
Typically, when you're looking at forming an entity, you have to weigh the pros and the cons. Cons, there's some expenses up front. You're going to have to pay an attorney if you want it done right to set it up. There's fees that you're going to have to pay to the state of California. You're going to have to typically prepare separate tax returns for that business, and so there's the cost of that.
Okay.
On the pro side, if you're using a limited liability company, regardless of the tax issues, you are separating that property from your own personal property if there's liability. So if there is a tenant that sues, or if you have commercial property and somebody slips and falls, and they sue the property owner for failing to maintain the property properly, then they can sue the entity or LLC, and if they win, they can go after the assets in the LLC, but they can't go after your personal assets. So they can't go after your
Gotcha.
house. They can't go after your bank account, your personal bank account. They can't go after your stock portfolio. So that's usually a primary purpose for setting up an entity. I'm always asked, well, I just have one house that I'm renting. Should I do it? That's a tougher call. You know, if you have a shopping center, yeah, absolutely.
Right.
Easy call.
Makes sense.
But as the size of the investment gets smaller, you have to weigh those costs and the benefits. On the tax side of things, under the brand new law, it's very complex, but there is the possibility of getting up to a 20% deduction on businesses that have what's called pass-through entity income, which
Okay.
an LLC is one.
Okay.
There's all kinds of nuances and exceptions for qualifying for that, and so you need to see your tax professional to see if that applies or not. Also, the state of California will have what's called a gross receipts tax for an LLC. If you have gross receipts, so the rent only, not considering the deductions for a rental property from $0 to $250,000, it's $800 a year. And then it's stepped up when you hit these certain thresholds. So from $250 to $500 is another $900 a year. The top gross receipt is $5 million, and at that rate, the tax is about $13,000 a year. That's the state of California.
Wow. So you really need to meet with someone on the front end because I'm sure
Absolutely.
your average person has no clue what
And on top of that, Ed, a lot of questions we get about the multifamily versus single family is specifically property tax. So is it a difference what maybe San Diego County charges on property taxes for a single family, maybe your one townhome or condo versus that multi-unit, that residential 4 to 6 or 8, 12 unit property?
So when you're looking at property tax, you start with a base 1% tax that is statewide. And from there you have add-ons depending on what community the property is located. You may have certain bond measures that are paid through property tax. You may have Melloru's. You may have HOA that's collected through property tax. All different types of things that could be through that property tax. Typically, on average, I like to look at about 1.25%, something like that, of the purchase price. Then, because the state of California passed Proposition 13 in the 1970s, the amount that your property tax can increase every year is limited to a 2% increase. Okay. And so there's really no difference between the multifamily property and the single family property. There is a rental unit tax that is assessed per unit. And so if you have a multifamily property, you're going to pay more in rental unit tax.
And that was going to be my next question. And we have clients who say they get a letter from the county assessor saying to fill out, is this a primary occupancy property or is it a rental property? And so again, we have to tell them we're not experts in that. Okay, you got to talk to a tax attorney. So that's the next question. Right?
So your primary residence is not an income property. You bought a house, you're living in it. It's not a business. You get a $7,000 deduction from your property tax basis for your primary residence. So it reduces your property tax a little bit. Very small amount.
Right.
Yeah.
1% of $7,000, so $70 a year.
Right. Thank you, California.
Yeah. So back to your question, Clara, the differences between investing in multi-unit and single family. What we've seen is multi-units the landlords tend to absorb more costs when it comes to like utilities or general maintenance.
Right.
A perfect example of that would be for a multi-family, you have landscaping. Who are you going to charge tenant in unit 3 for the landscaping? You can't do that. When it comes to single family, then obviously you can negotiate that at the lease and have the tenant take over that cost. And again, with utilities, you can't really divide up, the trash or the sewer bill in a multifamily. But so it's just things that you need to research before doing the investment, but there's a lot of pros and cons.
Just weigh your options and see what makes sense for you.
Yeah.
I have a question regarding, like, say I'm living in the house still, but maybe I want to rent a room. Does that change anything? If it's technically my primary residence?
From a tax perspective, now you have complicated your situation a little bit.
Give it to me.
Because you have to allocate to the portion of your real estate that is a rental property, things that you could allocate for an investment property. You have to allocate everything else to you personally. So you could look at it from a square footage perspective. There's no black and white rule on how to allocate it, but you have to have a reasonable basis for allocating.
Okay, understood. So maybe as far as ROI, what are you guys seeing on the property management side as far as a really good investment?
Well, there's a couple different figures that I think investors are looking at when trying to purchase an investment. And first and foremost, the difference between investing in a single family or a multi-unit, a lot of times, as Ed stated, is it's going to be the cash that you have in your pocket. If in California you have less than $1 million, there's not a lot of multifamily out there. Now, if you have $5 to $10 million, a multifamily property may be the right investment for you. And it's simply a matter of the number of doors on the property. You're paying less per door on a multifamily versus a single family. So that's first and foremost. The second part is investors are looking at different numbers, such as cap rates, return on investment. We used to say, hey, if it was 6% or better cap rate, that's a go, and anything below 6%, I'm going to pass. Nowadays, cap rates are a lot lower than that. So again, a lot of it stems from how much money are you putting down? Are you getting a mortgage? Are you not getting a mortgage on the property? And these are the way we're looking at investments. Each investment is different. You have to weigh out both the tax items that Ed had talked about, as well as some of the overhead expenses that Yuri brought up. How much is it going to be to cover utilities or common area maintenance. And then lastly, capital improvement. So one of the things that Golden West Management will do for you or your realtor, if you're looking at a property, we'll go ahead and do an underwrite of that property.
Oh, okay.
And it's not just looking at the market rents, which we can do, and a lot of people can do, but it's also taking a look at the budget, looking at, is it pie in the sky, or is it a pro forma, or are those real actual figures that you're going to pay when you purchase that property? In addition, we'll look at the long-term capital improvements. For a single-family property, that might be a roof, or that might be a water heater, but for a multi-unit, that might be a lot of water heaters, or a lot of HVAC units, or a lot of common area items that, again, we're not just realtors, all right? We're a licensed property manager, that's our specialty, and those are the things that we're going to be able to do for you as an investor when you're looking.
So not only will you underwrite it, but you also advise your clients on, let's weigh the options here, what might be a good idea, what may not be a good idea, and also how to achieve their goals. So talk to me a little bit about that side of your business.
Yeah, so absolutely. You want to integrate all of your legal planning together. And so in this case, we're talking about really, you have a business. You're also going to have a personal side. So on the personal side, I advise clients on trust and estate planning. And we want to integrate that into their business ownership as well. And so you may be creating a revocable living trust for the family to protect the family and give direction and legal authority for transfer of property and caring for the family should certain events arise. But you want to tie that into the ownership of businesses and assets that the family has. And so if the family invests in apartment buildings and they've done their estate plan, well, you want the ownership of, let's say you're concerned about liability, so you want a separate limited liability company for each apartment building.
Right.
You want the ownership of that to be the trust that you created for the family. So it all is seamless, it all flows together. And so you're having some protection from liability. Of course, you're always going to look to proper insurance coverage. That's always your first line of defense. But then you could separate your exposure by each property being isolated on a separate island by using a separate LLC for each of apartment building in this example.
Yeah. What would the consequence be if you don't put the properties in the trust?
Well, that's a great question. So now some liability arises on one of the apartment buildings and you're sued, you go to court, you lose. There was insurance, but it wasn't enough. So the insurance pays out for the limits. They get a judgment for the balance. The judgment is more than the value of the apartment building. They can start collecting on all of your other assets.
Oh boy. You don't want that to happen.
And what about, Ed, would you speak a little bit about, this question comes up quite a bit from our clients. They ask about what to do in the event that tragedy happens and somebody passes away. What are the consequences if you're in a trust versus if the property is not in a trust with, for lack of a better term, maybe a death tax, or what are the heirs going to have to be working with?
Great question. So in California, if you own any real estate, unless it's worth under $50,000, I've had one.
My bathroom.
$50,000.
$50,000?
I've had one situation where that occurred, some property in the desert. If you don't have a trust, typically, there are exceptions. I have a degree as a jurist, or as a JD. Do you know what that stands for?
Juris Doctor, right?
No, just depends. Everything's,
Funny.
everything just depends. So,
Good point. Good point.
generally speaking, you pass away, you have to go through a court administration known as probate to get clean title to the property to the heirs. That can be 18 to 24 months.
Wow.
There's lots of expense involved, including paying your attorney. So what I like to say is either pay me now or pay me later. Either way, I get paid. You can avoid that with a trust, because a trust is a private administration. You don't have to go through a court process. You don't have to have court oversight to get legal title transferred to your intended beneficiaries. So that's number one benefit. But in addition, you can decide exactly how your property goes. You may not want to give full outright control to your beneficiaries. Think about having minor children.
Right.
You may want it managed for them for a period of time or even for their life, or maybe for multiple generations. You can set it up that way. Right. So you have all kinds of flexibility, and you can design your legacy plan the way you want.
Can you be very specific with stipulations that you want?
Absolutely.
Like to the T?
To the T.
Like for the triplets, you know?
Yeah, like what would you do
Yeah.
with your triplets?
Sutton, the boys are only getting a little bit, but Sutton rules the roost.
You could say if you don't get a B average in college,
Right,
we don't pay for it.
Hear that?
Wow,
Hear that,
okay.
kids?
I
Hear
like
that?
it.
Some good knowledge.
I like that.
Yeah, that's what my parents would do. My dad used to get so pissed if I would come home with a B. Shout out to you, Timmy McKee. I know you're watching. Guys, we're rocking and rolling right now. So if you have questions for Golden West regarding the real estate investment side, or maybe you have a question for Ed regarding the tax side of things, drop the comment below. We want to hear from you. And a little shout out to Alexandra Fry. She said, rent it like.
You mean
I
it.
can mean it, yeah.
Hey, all right, cool, guys. So I know you wanted to talk about, Jason, the advantages of the different entities. So an LLC versus a C Corp or an S Corp. You get that question a lot, huh?
And again, a lot of it is my first and always our first response is we are not a tax attorney. And we can tell you what we see as an experience, but we're always telling you, the client, talk to a professional. Talk to somebody like Ed that's going to advise you what's best for your specific situation.
Yeah, we have clients. I'm sorry, Tim.
No,
We
absolutely.
have clients that come to us and they just want us to know everything, and we have to protect ourselves as well. So it's really great to forge relationships with someone, a specialist like you, just so we can refer that to you, or you can kick back some answers to us as well.
Because I don't have a JD,
Yeah,
so
so-
I don't. I'll
You have a
I'll look for-
JD.
I'll
So
look
it doesn't just depend for you.
yeah, it doesn't just, but specifically,
Yeah.
people ask us, okay, should I set up an LLC, or I have young kids, should I set up a trust? And so when we're pushing them over to you, what are a lot of things, the questions you're asking them for them to make that decision?
So having a broad overview of the different types of entities help. First, when you think of what we call a C corporation, which is any corporation that would be publicly traded, that you can buy stock, General Electric or what have you, there's a two-layer or double taxation for that type of structure. The entity itself gets taxed.
Right.
When dividends are paid to the shareholders, they get taxed. So for most small business owners, they don't want to do that. Now, there is a very favorable rate with the new law, 21% versus 35% is what it was before for a C corporation, but you still have the double taxation issue.
If you touch the
So,
money, you're gonna get
right, once it comes out, you're going to get taxed again. So usually the question comes down to between a limited liability company and a subchapter S corporation or a small business corporation. Both are pass-through entities. From a federal tax perspective, both are taxed the same. State of California taxes them a little bit differently. State of California will tax an S corporation based on its income at 1.5% for the state of California, and an LLC has the gross receipts tax that we talked about before. Generally speaking, I think an LLC is a great vehicle for a holding company, a non-operating type of business. So an investment in real estate, LLCs make a lot of sense. S corporations typically have more advantage if it's truly an operating business, maybe a service business, a property management company, for example.
Cool. How about 1031 exchanges? Has that been
Right.
affected at all?
So 1031 exchanges have been affected by the new law, but only for exchanges that don't involve real estate. So you could do a 1031 exchange before the law with a property that was held for productive use in a business other than real estate, and you could exchange it. So it could be equipment, for example. And you could exchange it for other equipment and not recognize
It has to be
the
like
tax.
kind, right?
It has to be like kind. But for real estate purposes, no changes.
And what is the actual, people that are layman's with 1031 exchange, they say, okay, well, I'm going to do a 1031 exchange when I sell a property and I'm going to save the taxes. What does that really mean, save the tax? Where are they saving tax figures?
It's not tax-free, it's tax-deferred.
Tax deferred.
And that's a key point. When you properly structure a 1031 exchange, you are swapping properties.
Okay.
You have a property now, you're going to end up with another property, and you are not recognizing the gain on the property that you're relinquishing, you're deferring it. You're taking that tax basis in the property that you own today and putting it into the property that you're acquiring. So if you sell that property in the future, you'll be taxed on your old tax basis. Now, my family's been in real estate a long time. My dad had a company in the 1970s called Apartment Investment Realty, where their mantra was exchange until death.
I like it.
Why is
That's a
that?
good slogan.
Yeah.
Why is that? Because there's another tax code, 1014 of the Internal Revenue Code, where when you receive property through inheritance, you get a basis adjustment to fair market value, stepped up basis. And so you can exchange your entire life, not recognize any tax on those exchanges under 1031, and then your heirs receive the property. They get the property with a basis at fair market. No, they get the property with a basis at fair market value at death. They can sell it the next day. Well, what's it worth? Fair market value.
Fair market value, okay.
So what's the difference between what you sold it for and the basis? Zero. You pay no tax.
Really?
Interesting.
So it's not
So
from
exchange
the-
until death.
Exchange.
Yeah.
So with inheritance, it's not what the original basis is. It's what it is at the end.
That's right.
Wow. Okay. So great knowledge. Great knowledge.
So just keep exchanging. In theory, you just keep passing it down and no one ever has to pay the tax because it's just continually deferred, right?
That's right, if you do it right.
Roger that. Okay. Got it. Ed, I have gone this long without giving out your information. bkflaw.com, right? We can find out more about you. and-
Absolutely.
So that is bkflaw.com. Again, he's with Blanchard, Krasner, and French, and that's Edward Schlesier. He is a certified specialist in estate planning, trust, and probate. And obviously, he knows his stuff, right?
Right, absolutely.
And we also have Jason and Yuri with Golden West Management. You can check them out at goldenwestmanagement.com. And Jeremy Ragland is coming through with some good questions. He said, well, we'll do this one first, Ed. He said, what exactly does like kind mean? Is it similar property or similar property value?
So this was an area that was heavily litigated about 40, 50 years ago. In the real estate space, what resulted from all that litigation is really any investment real estate for other investment real estate is like kind.
Okay.
So it could be a property that is agricultural, growing crops, that gets exchanged into an apartment building, that's like kind.
Okay, interesting.
Is there a value attached to that? Does it have to go up in value? Can it go down in value? So if I have a property that's worth $1 million and I want a 1031 exchange it into a property that's worth $500,000, can that be done or no?
It can be done, but you're going to recognize some tax.
Okay.
So when you take a property that you're relinquishing, you're selling, and you're exchanging into another property, if you exchange for a property for lesser value, you're going to recognize what's called boot, which is taxable. So you can exchange, the value of a substantial portion potentially, but you're going to recognize some tax.
Is it 1-to-1? Could I buy two different investments with that 1 million, say, two for 500,000?
Absolutely. You can
Good question, right?
invest in as many properties as you want, so long as you get the values to match.
Interesting. And I know there is some regulation about like close of escrow, you have to determine it by this time, and people are like, oh, I want to do this, and they wait too long and then they can't. So can you advise on that a little bit so people don't find themselves in that position?
Yeah, 1031s are very technical and non-forgiving.
Yeah.
Oh, wow.
You must identify the property that you're going to exchange into, and you can have multiple properties. There's different rules. There's a 3-property rule that's commonly used. So you have one property you're selling, you identify 3 properties, one of which you want to exchange into, you don't know exactly which one. Within 45 days after sale, you identify them 46 days later, you just recognize the tax on the sale of the property.
Don't find out
It's
the
not
hard way.
forgiving. And then you must close, you must actually complete the purchase of the other property within 180 days.
Wow. Okay.
Does your company handle, are you guys an intermediary for such 1031 exchange, or you usually farm that out?
No, we found that let those specialists do their job. So 1031 accommodators or qualified intermediaries is a very important function for the 1031 exchange, and you want to have someone that's very experienced in doing that.
Absolutely.
We got another question from Jeremy. This is for you, Jason and Yuri. What tips do you have for new investors just getting started with investing in San Diego real estate specifically, especially after the tax reforms?
Well, again, I think the most important thing is you need to know what specifically is going to work for you, cash flow wise. What do you have in the bank that you can set out for an investment purposes? That will dictate what type of property you might want to invest in, as well as the areas you're going to invest in. San Diego's can be a little bit expensive right now, so if you only got, what do we say, $50,000, that might be a bathroom around here.
A
versus,
tent.
Could
You
be
could
a
get
tent.
a nice tent.
So that would be my first recommendation.
Figure out what your goals are, right?
Right.
So we've covered a ton of information, and I just want to come back to the both of you, and what do we want to take away? What's the golden nugget that people need to remember?
Well, again, we are your local market experts, so when investing, just know that we kind of are that one-stop shop that you can come to, whether you are wanting to invest, you want to rent your property out, you can come to us, and if we don't have the information, we will source that for you as well.
Absolutely.
Got a lot of resources.
And again, that's what really matters. You don't want to work with a company that's going to give you all the answers when they're not the expert. Mm-hmm. Let us focus on what we do best. Again, we're not realtors who happen to be property managers. We're licensed agents that handle residential rentals on a regular basis, and that's the specifics.
Amen. And that's goldenwestmanagement.com. Check them out if you have questions or want to reach out. They will give you the hookup. And then Edward Schlesier, a certified specialist in estate planning, trust, and probate with Blanchard, Krasner, and French. Whew, I need to take a breath
Really
after
long
saying
one.
that, Ed. What is the takeaway? What do people need to remember?
Exchange until death.
Exchange until death. That should have been our slogan,
That
the
should have
title
been
for
it,
the
so.
show.
No, but
Hashtag.
more seriously, get proper advice on the front end, as opposed to getting yourself into trouble and then seeking that advice.
Yeah, tail between the legs, uh-oh, right? That uh-oh moment.
Definitely applies
Yeah.
to a lot of aspects.
Check out Ed at bkflaw.com. He is happy to hear from you. And guys, thank you so much for watching. Lots of good questions. We appreciate you tuning in. Jason Lopez is coming through with a last minute question. Like kind means a property held for investment. Doesn't matter property type. Oh, he's answering the question. Thank you, Jason
There you go,
Lopez,
Jason.
for weighing in. Appreciate it. So thanks for tuning in. This has been Real Talk San Diego, coming to you live from Smarter San Diego Studios, bringing you the business of life in America's finest city. Go love everyone, and we'll catch you next time. Thanks for watching.